north-south divide is real. Property prices in the north can be nearly 5 to 20 times cheaper than property prices in the south. You can even get property prices as cheap as £15,000, £10,000, even as low as £5,000. And the relative returns and rents can be enormous. Take buying a property for £35,000, renting it for £450 a month. That's a 15% return on investment. Compare that to what you can get in the bank. But have you ever wondered whether it's worth it, whether you should invest? Is there a small little voice in the back of your mind saying, what are they not telling me? So in this video, I'm going to reveal the pitfalls you must consider, as well as the simple blueprint and system that a few investors adopt to really harness this strategy and answer that question whether it's right for you or whether it's not. But have you ever wondered whether it's real? Whether you can easily invest in these type of properties at that price point? Last year, we personally invested and bought several of these cheap properties. Let's show you a few examples. We bought this for £20,000. And here's another we bought for £15,000. So yes, there's a number of these type of investments, and with the right type of research, as well as working with the right team, you can really invest in the right type of opportunities. But I'm sure you're thinking, what are the risks? What are the pitfalls? Well, I'm going to be honest, there's a big reason why these properties are so cheap. Commonly, these properties are going to be in areas where employment opportunities are relatively low and crime rates are higher. And moreover, due to this, the number of homeowners in that area will be lower, and there'll be a higher proportion of properties owned by landlords as well as social housing providers. So to summarize, there's several limitations when investing in these type of properties. So 1, typically you're going to encounter more challenging tenants. 2, capital appreciation is going to be low to non-existent. 3, demand from tenants can be a roller coaster, and it can be super challenging if you're considering self-managing. And consider this, 1 or 2 major repairs, especially if you're not doing really good effective management, can wipe out the profit for that year that you've made. So has this got you thinking, maybe I'll stay away, maybe this isn't for me? Well, I'm not going to sugarcoat it. These are some of the big challenges. But what if I told you there is a way to really make this work for you, when done right? See, I'm originally from London, an area called Brixton. Maybe you've heard of it, maybe you've not, which was notorious for high amounts of crime rates, depreciation, and a real lasting stigma. So when my parents bought their property back in the early 1990s, they bought it at £40,000. Sound familiar? So now the same house is worth a whopping £600,000, and it's on a council estate area. So there's 2 simple strategies I know a few select investors are adopting to make this work for them now as well as in the future. Number 1, safety in numbers. Ever heard of a HMO, house of multiple occupancy? It's effectively renting the house room by room, having several tenants pay you the rent, and if one tenant moves out, you're still going to be getting income, really reducing your risk. So adopting a similar approach, it's about investing in several of these cheap properties, and so if one goes wrong, your risk is minimized because all the other properties are making up for that. Adding to this, putting the right type of property management and lettings team in place will really help safeguard the property. But whilst cash flow security is key, what about capital appreciation? That brings me on to the next point, long-term capital appreciation. A key driver of price growth is local investment, infrastructure, schools, roads, the list goes on. So the astute investors I know add fuel to this strategy by investing in cheap properties in up and coming areas. But how do you know what's up and coming? How do you identify these hotspots? That's where undertaking research and doing your due diligence is very, very important. Working with the right type of property professionals who know the areas really well will really unlock this opportunity for you. So right now, you may be thinking, is this right for me or is it not? So if you're looking to get rich overnight and you only have, let's say, £25,000 to invest, I'd probably recommend not. But if you can play the long game, understand that diversification is key, then this could possibly work for you with double-digit returns on the investment. So if you're interested in taking the next step and working with the right type of team that know the right areas that will help drive capital appreciation and cash flow, then just click the link below and it'll take you to a page where you can get access to our Property Investors Toolkit. This gives you access to off-market deals, analyzes, and actually helps you decide whether this is the right type of property to invest in or whether it's not. Finding the right team to invest with can be hard, but assessing an area for long-term growth when you're not from the area can be super challenging. So in this video, I've created a detailed tutorial on how to find your next gold mine location.